All right, welcome back to the channel. In this video, let's talk about the interest rate changes that is happening at Navy Federal. Let's dive in. All right, so at first, I actually wasn't gonna make this video. I brought it up in the comment section of the last Navy Fed update video that we did, which was just like a week or two ago, depending on when this is released. And I wasn't gonna talk about this, but it turns out that there's a lot of people confused about what is actually going on. And so myself and several other members have been calling in and talking to multiple reps, calling in just to make sure that everything is the same story that we're being told multiple times the same way, you know, et cetera, or similarly. And so now that I've got all of that put together, I wanted to shoot this video and share it with you guys. Now, I'm sure you've gotten this email from Navy Fed saying that there's gonna be revised terms to your account starting October 1st, 2024, right? Now, what they're talking about changing is they were on a flat rate system of charging interest, which means that everything for the last 30 days that has been charged and not paid off by the time the statement date rolls over, that is what we're getting charged interest on. And it's all at once, it's one lump sum of interest, and then it's charged at the beginning of the start of the next statement, right? Or billing cycle. So that's how it's being done currently. What they're talking about changing is changing it to a compounded interest rate style, I guess you could call it. And so all that means is that they're taking the APR, which is by the year, and they're breaking it down, dividing it by 365 and giving you your daily periodic rate. And what that is whatever amount the daily periodic rate is, that is what they're applying to the balance that is carried every single day. Now, here's where I think people are starting to get lost. I know that there's some YouTube videos that are kind of playing more of a dramatic angle on this, etc. But I can tell you that the difference in money isn't that much. We'll cover that in just a couple minutes. But also too is, yes, the interest is now being calculated on a daily basis, but if you still pay your balance off before the statement date or the statement due date, you pay zero interest. So it's not like if today I make a charge, tomorrow I start getting charged interest on it, even if I pay the bill tomorrow. No, there's just zero interest. So it still works similarly to where you have 30 days of interest-free money. Still works the same way. So it's not converting over to like a charge card strategy. I know people were concerned about that, and there's nothing else really to it outside of that. It's just now they're going to calculate it based on a daily basis with a compounded rate versus a flat rate 30-day. So balances carried over from last month to this month will still kind of work the same. You're getting charged interest based on that daily. So the sooner you pay your balances off, yes, the better, because the effective interest rate that you'll be paying is lower. Now let's talk about that. What are the changes that you can expect to your bill? Somewhere between $1 to $3 on a balance that's $5,000 or less. On a balance of $15,000 to $20,000, you're somewhere between the $8 to maybe $15 range. Now this would become much more substantial if you're carrying like over $100,000 balance, let's say. But I don't think that that's ever going to happen. The max amount that you can have is $80,000. I've seen a little bit over this, and again, I don't think you would want to be maxing that out. But I guess if you did, yes, at 50,000, at 70, at 80,000, the amount is obviously going to go up even more, right? So just extrapolate that out, right? And that'll give you the rate that you could expect. So yeah, it's not going to be as big and dramatic of a change that I think some people were thinking it was going to be, because I know that compound interest sounds scary when it's being used against you. So I completely understand that. But yeah, I don't think it's going to be that bad. So some other things to note is this is their response. So I've talked to multiple reps and gotten different answers. The first rep that I talked to said that this was to help fix the categories that they're using for transactions was getting messy, and across banks or intra-bank, I guess that would be called, from bank to bank, that can be kind of messy. And so they want to do this to better help clean that up, which, okay, I guess. And then the other answer that I got, which I thought was probably more in line, was that, look, everyone else in the industry, every single other bank has raised their interest rates. You know, we've got upwards of 29% by some of these banks. They're still maxing out at, I think, 18.49% is the max, but they don't want to raise their base interest rate. So instead of doing that, they're switching over to this model. And so the collective answer that I got is that there's a lot of banks that are going to be doing similar if they haven't already, and the daily compounded model is going to become more commonplace as people try and combat the, you know, the sluggish economy that now is just dragging on and on and on and on. So that's the answer there, and that's pretty much it. I mean, outside of that, there's not really a whole lot to cover. What I did find interesting in this email is if you scroll down, transaction categories, we revised the transaction categories section to clarify we may rely on information provided by payment networks to categorize transactions as purchases. Not a lot of people know this, but most credit unions, first off, they'll allow you to come in and load up your account when you first sign up for your account with a credit card. So they'll allow credit card loading of the account. So upwards of $2,500. And you can do this, go back and do this over and over and over again. Some of these banks will allow up to, you know, $2,000 to $3,000 a month that you can continue to deposit into your checking or savings account off of a credit card. And it's not keyed in as a cash advance, okay? A lot of credit unions actually struggle to classify cash advances, the categorization of it. They're definitely not like a Chase or Amex to where they have dedicated teams chasing you all over the place, trying to make sure that the categories are correct. Definitely not like that. Navy Fed, I think, has been very, very lenient with how they categorize things. I know of a lot of people get away with a lot in terms of they're doing cash advances in a slick way and they're not getting charged cash advance rates at all. It's just showing up as an ACH, regular interest rates applied to it, et cetera, et cetera. So that might be changing. I don't know if they've always done this or if this is a new thing that they're looking at doing, but yeah, relying on information provided by payment networks, I don't know if that's gonna be new or not. So if that does change as well, then just enjoy the time that you had that, that freebie, because that might be ending. But outside of that, that's really it. Yeah, it's not that big of a scary of a thing. They're changing to a daily rate. As long as you are paying your bill before the statement date, it is the same as it is now in terms of like rent-free money that you don't have to pay interest on. So anyway, that's all I got for you. If you got questions, comment below, or you got something else to add, maybe something that I missed you'd like to clarify, comment below, let me know what you think. And that's it for this one. We'll catch you in the next one. Thanks for watching.
Hey, you should subscribe. 60% of you are not subscribed yet. Right there. Okay, bye.